Sydney property prices are forecast to fall 18%. Today, we're going to look at this in a bit more detail. We're going to look at the areas that are going to be affected. We're also going to look at the factors that affect the values of properties to grow or decline. Stick with us till the end. We're actually going to cut through all the fear and look at this and look at the numbers and take a very straightforward assessment of the situation and try and understand what's actually happened. So starting off on the top, let's have a look here. So PropTrack is forecasting property values to fall up to 18% across Sydney. Firstly, let's start off with understanding who PropTrack is. Later on, we're going to run through the numbers and see what's actually going to happen. So stick with us till the end because we're going to cover a lot of details that will help you, especially in this time, which is quite challenging. So PropTrack, they're effectively a leading industry software company that really crunches the numbers for property statistics. They do reports such as AVMs. These are known as automated valuation modeling assessments that the banks use. They also have a desktop valuation tool that valuers use, and they actually were acquired by REA Group, which is realestate.com.au. Typically, they do reports or can generate reports such as this CoreLogic one, which gives you like an estimated value on the property. So they've got a bunch of data there, and they've recently come out saying that they foresee property values to decline in Sydney by up to 18%. So Sydney property is tipped to plummet 18%, with houses in Northern Beaches, Ryde district, and inner south likely to be the hardest hit. Well, no doubt, looking at the Sydney map here with CoreLogic's mapping data, we can get an idea on the median value in these areas. So Northern Beaches on this side here, we can see a lot of these values are in the 2 mils, right in the middle here, once again in the 2 mils, and the southern areas, once again in the 2 mils. So these are the upper areas in which properties are going to be hit the hardest. And we do see this as an ongoing theme, particularly as borrowing becomes more challenging with rates going up. The ease of credit has a direct correlation between values of property. So we'll run through that a little bit. We'll got some interesting data on that, so stick with us on that and we'll run through what that actually looks like. I guess with the 3 consecutive rate hikes that we've seen, soon to be a 4th coming up on Tuesday, higher inflation, we're seeing that buyers are pulling back from the market, which has caused a drop of 1.5% from the peak in February. Now, we only need to have a look at the home value index to get an idea. Well, Sydney being the largest, or New South Wales, the capital city, the most expensive median value across the country, we're going to find that Sydney and even Victoria is getting a lot of the headlines, given that with lack of credit, your ability to borrow is reducing, values are naturally going to go down because buyers are unable to secure the same sort of funding. I will run through the correlation between credit and the ease of credit and how that plays a part in borrowing. So we will run through that a little bit down the line and a little bit. We can also see the values declining here. So monthly change for Sydney down 1.6% based on CoreLogic data. For the quarter, down 2.8%. Now, the modeling that PropTrack shows that the worst is still yet to come, with prices potentially to fall a further 3 to 6% this year, and then tumbling another 9 to 12% by December 2023, the end of next year. What we do know is the forecast for interest rates are going to be peaking next year. They're talking about 3.35, depending on which economist you're talking about, which makes sense. So property values to fall in tow with the lack of credit that will be available. Now, let's talk about credit and how that plays an impact on people's ability. Got a bit of information here that I did want to cover. The first is we saw KPMG recently reveal minimum pay rates. This is just going to give me an idea of what income we should use just for an assessment here. So let's just say, for someone as an assistant manager or a general manager, anywhere in that 81 to 110, 111 mark. Let's just say we've got a couple, one of the applicants is working, earning 100 grand a year. Well, let's look at how interest rates increasing will directly affect their ability to borrow, which in tow really reduces people's ability to secure properties at higher prices. So 2 adults with a household living expense of $3,000. Now, remember that because I do want to come back on that. One person's working in the household, just to make it easy for today. The banks have an assessment rate. So this assessment rate is typically the rate that you can secure plus 3%. So let's say previously what we found at the lowest point, the assessment rate was 5.25%. So at 5.25% for this couple, their borrowing power is 585. At the moment, with all these interest rate hikes we've seen, the variable rates you can get in the market at the moment are higher than what this is here. So the variable rate you can get is 3.24. What that means is add 3%, the assessment rate actually goes up to 6.24%. That reduces your previous borrowing power, what you could previously get, from 585,000 to 525,000. So we can see every time there's a rate hike, borrowing power for buyers is going down, which means that property that they previously wanted to buy and had enough deposit for is now needing to be reassessed and their budget reduced as well. So it definitely doesn't surprise me that we're going to see values going down with interest rates increasing. We'll run through some data that we've got through ABS in a minute, just talking about how in the past 30 years values have changed, mainly due to credit criteria becoming easier and income growth. So they're talking that the fall of this magnitude puts those that purchased last year with small deposits at risk of having a mortgage that is really larger than the property. So then we call this negative equity. The Reserve Bank is across this. They're keeping a keen eye on this. Look, I think for those that have purchased last year and had long-term views, we know property is cyclical. So, you know, it booms, it busts, it recovers. We can see that here with her and Todd White. They have a national property clock, natural part of the cycle. So the Sydney property market is starting to move to a declining market. It will bottom out and then no doubt rise again. So that is certainly something that's happening. I mean, also putting in perspective that we saw the strongest annual growth in properties on record only at the end of last year. So if we look at Sydney as an example, that had an increase of 26%. So we're seeing some of those gains move back to a pre-pandemic state. We saw Brisbane last year with a 27% increase and Melbourne as well as a 20% increase. We can see here in this graph since 2004, how that cycle sort of operates. We go from heights of 13% growth right down to negative sort of 4. So boom, bust, as we can see here. And a lot of that has to do with credit and the availability of credit. Another thing is how banks are regulated. So one of the regulation measures is called the household expenditure measure. So this is where the medium, the household, what they call it HEM, the HEM is really defined by the medium spend on absolute basics plus the 25th percentile on spend for discretionary basics. So what are absolute basics? Well, that's food, children's clothing, utilities, transport costs, and communication. Plus, they'll add the 25th percentile spend of discretionary basics. So that's takeaway food, restaurants, confectionery, alcohol, tobacco, adult clothing, and entertainment. So what we found as well, interest rates increasing reduce borrowing, but the household expenditure measurement is also HEM. The HEM is increasing. So previously, we had for two adults on a sort of an income of 100,000, the banks would say, well, that household expenditure might only be $1,900 a month. Now they're looking at it $3,000 a month. When it goes up to $4,000 a month, the borrowing power reduces then again. So you go from 525 to 366. So that's another factor that plays a part in the borrowing ability. Now, the banks also look at your HEM, your household expenditure, based on not only the minimum, they've benchmarked out a minimum. So even if you're spending less than that, they'll benchmark it in that. They'll also look at things that are additional, such as private health, school fees, things that aren't considered your basic living expenses, they'll add that in, which also reduces your capacity. So what we do find is as these basic living expenses increase, so will your borrowing power as well. So interest rates play a part in borrowing and your household living expenditure as well, which has a direct effect on the ability to borrow. Now, what we are starting to see is if we compare how we got here and what plays a part in values and property prices increasing, well, the main thing here is, as I talked about earlier, if we look back since the 80s and we reflect on where things have gone, the main factors that have an increase or drive values of properties up are twofold. The first is in the 80s, we saw a decline in the average nominal interest rate. And as a result of this decline in inflation in the 90s, it meant that borrowers could service larger loans than they previously were able to do that. So as we see rates go down, people can borrow more money. That increases property values. The second is the deregulation of the financial system that reinforced this trend by removing many of the previous constraints on credit supply to households. So by the mid-2000s, this structural transition seemed largely complete, and the average household prices settled at around 4 times average household disposable income. Now, let's have a look at this graph here. We can see dwelling prices. So in 1982, dwelling values were in the $40,000 mark for Australia. This red line is Australia. We can see over the years, as those two things have changed, interest rates reduced, regulation eased, values in tow had a big change. So let's have a look at the Reserve Bank's cash rate and get an understanding of where rates were previously. And I know my parents always talked about this. Rates were at that 17, 15%. As we see that's slowly declined over the years, that's had a big impact on the values. The other thing that we've seen is debt to income ratio. So price to income ratios. Previously, as a percentage of income, people were borrowing 2.5% of their income. As the banks have deregulated, we're sitting in around that 6%. Even nowadays, we're getting lenders that'll do above 6%. So the reduction in interest plus the loosening of bank criteria has meant people have been able to borrow a lot more money and has had a greater impact on the values of properties. And that's what we're seeing here with this contraction. We're seeing reduction in borrowing power, having a knock-on effect for borrowers, as well as other things like consumer sentiment definitely coming in there as well. As we have a look here, we talk about, potentially we might find another cash rate increase. We talked about that earlier, where we're going to get to that 3% by Christmas. This will significantly reduce the borrowing capacity of buyers in higher price markets, which in tow makes sense as to these more expensive areas having price reductions and price falls. We're seeing that already in a lot of these areas, recording up to 7% decreases, and mainly due to the fact that borrowing powers have reduced. So Northern Beaches, Ryde, and the city and inner south, we're likely to experience the largest falls, with the outer southern west, Blacktown, and Blue Mountains potentially could be better protected as they've got increased first homeowner activity. And I guess for a lot of home buyers in the last sort of 12 or 18 months, they've been really priced out of the market. So finding a little bit of silver lining where prices are coming backwards, they've got a little bit more wiggle room, they can negotiate. We're starting to see them come back in the market. We also see that they mention now prices would need to fall 22.8% to get to pre-pandemic levels. So that's just to wind the clock back before all this craziness happened. We saw Tim from LJ Hooker saying that they've seen a shift in properties and some properties actually selling 10% cheaper than their peak. We also saw Monica from Ray White talking about Bondi Junction, saying that there's been a drop of 10 to 20% over the last 3 months. So that's a real estate there working in the area. And Nuri from Bell talking about first homeowners, that they're returning to the market, particularly as prices fall. Finally, with Rebecca from Hallmark, the buyer's agent, saying that premium houses in the Northern Beaches we're still selling, and there's possibility to negotiate up to 10% for less desirable homes. I guess the main thing here, guys, is to remember, yes, prices are going down. Yes, there are a number of factors that play into it. Ease of credit is definitely one of the big factors, as well as interest rates increasing, meaning that the borrowing power is reduced, and regulatory restrictions that the banks have really play a part in all this. Here at Hunter Galloway, we help home buyers across Australia. We're based in Brisbane. If you're living in Sydney, you're in Melbourne, anywhere else across Australia, and you're needing assistance with finance, give us a call on 1300 088 065 or visit us at huntergalloway.com.au. Did you know there's no cost for our service? We help with anything that you're looking for: refinancing, buying your first property, investing or upgrading or downgrading. Call us today and we'll talk to you soon. Thanks again, guys. We'll see you next time.